Welcome back, you legends. I'm Dr. Cal. Let's get right into this video. Today, the stock market is up 0.34% on the S&P, 0.64% on both the NASDAQ and the Dow Jones Industrial Average. Let's take a look at the different sectors. Leading today was energy, followed by basic materials and real estate. So leading were the inflationary sectors. So after the CPI came out, we saw the inflationary sectors lead: real estate, materials, and energy. Lagging were defensives, utilities, and healthcare. So we're seeing the defensive sectors like consumer staples, like utilities and healthcare finally lagging. So we're seeing a bit more risk appetite in the market, with market participants laying more and more into energy, real estate, industrials, as well as materials. Interestingly, tech did okay. Microsoft up 1.1%. Semiconductors, Nvidia, AMD up significantly today. Qualcomm as well. And then we have software, both Salesforce and ServiceNow, both up significantly on the day. Meta up big time. Disney up big time. Boeing up big time. Financials are doing okay ahead of key earnings tomorrow. So stay tuned for bank earnings. They will likely do okay. I do not expect a deterioration in the earnings from banks until maybe the middle of this year. So we're seeing risk taking in the market, a risk on rally, but in the wrong sectors. In the inflationary sectors, we saw a similar rotation into inflationary sectors back in early last year, and it was a bad time for stocks, as you all remember. So I do not really like to see this sort of rotation. So just be aware that we're seeing rotation into inflation after the CPI report came out, and this tells me that market is betting on inflation returning in both energy and materials. Let's take a look at the daily chart for the S&P 500, and we ended up with the doji, the indecision candle that I talked about yesterday. One of three possibilities: a gap up and a sell-off at the open, or indecision doji. We got the indecision doji. We had the gap up, we sold off, and then we went back up. This is called a hanging man candle, a candle with a long wick, or a tail, and a short wick. The wick is up top, the tail is down below. A long tail and a short wick. And these hanging man candles usually indicate the end of a trend. When they come at the end of the trend at the bottom, they indicate that the sell-off is over. When they come at the top, they usually indicate that the rally is over. These candles do need confirmation, however. So we do need to see a sell-off tomorrow to confirm this hanging man candle. If we don't see that, if we see another indecision doji or another rally, then perhaps we could see the market hover around these levels for a little while longer. Remember, next week we'll have a shortened trading week, so 4 trading days. These shortened trading weeks tend to be bullish, generally speaking, not always, but generally speaking. I remember that last year that shortened trading week was actually an utter and complete total disaster. So we're not sure quite yet. We could see another sell-off. We don't know quite yet. On the daily chart on the PPO, we're still trending up. We're still pointing up. The histogram is printing bigger and bigger green candles. This was a little different from what we had back here. Right, we had already started to see a downtrend in the histogram on the PPO. We had this final top and then the massive sell-off. This confirmed the beginning of the bear market. We'll see if that happens next week. Odds are that we'll see the market continue to hover at these levels, pull back towards the end of January, perhaps retest this support line, form another top, a double top, another rejection, and we continue to move to the downside in February, mid-February, something like that, into March and April. Now on the 1 hour chart, guys, we do have a bearish divergence. We have this double topping formation with a slightly lower high on the PPO, right? We do have this pennant, this symmetrical triangle forming at the end of the day. If you go back, sometimes you see these bull flags or symmetrical triangles breaking to the downside with a gap down. This is an example. Right, we had this bull flag, then we gap down. Another example is this bull flag, then we gap down. Another example is this, a bull flag, then we sold off. Another example is this, a bull flag, and then we had a gap down. So that's common, guys. Another one is right here, a bull flag, and then we had a gap down. We don't know if the market is going to gap down. This doesn't always happen, but it could happen tomorrow. Just keep your eyes peeled for those financial earnings tomorrow, those big bank earnings coming out tomorrow before the market open. Overall, this uptrend is likely still ongoing. It hasn't ended quite yet. We opened just below the 20-day moving average. We crossed above it. We got rejected. We went back down. The bears took over. They sold off, and then the bulls came back in, pushed it back up, and we are now above yesterday's close and just below the 20-day. The 200-day. So we will likely see another attempt at the 200-day, and I suspect that we will end up closing above it. The question remains whether we will close above this descending resistance line or not. If you are long, if you went long here, this makes sense to take profit at this level. The upside left is not a lot, not much upside left on the indices. On specific stocks, there is a lot of upside left on some specific stocks, but you will have to be a stock picker, not an index investor. At this level, for the index, for the S&P index, I don't see a lot of upside left, perhaps just 1% left in terms of upside, at least for this week. Now, in terms of projections for next week, I do expect the market to hover around these levels and then sell off in the, let's say after the 20th of January, we see a retest, a double top, another rejection, and then we sell off into February and into March. This is my projections chart. I share this chart in the trading community. By the way, guys, you can join the trading community by clicking on the link below in the description box below the video or at the comment up top in the video as well. Now, I want to point out something important, a major development that I noticed today that looks eerily similar to 2008. Look at this, guys. The VIX has crossed down below 20, has formed a bearish crossover on the PPO. This looks to me somewhat similar to the final rally before the 2008 crash. The VIX was in an uptrend and it finally broke it. The market rallied for 5 weeks before the first major leg down in the market. I think we are witnessing a similar setup right now, with the market likely poised to continue to rally or at least consolidate until early February. This is what I'm talking about, guys. This is 2008, right? We had an uptrend in the VIX, putting in higher lows, right, and higher highs. Then we ended up closing below this support line or uptrend right over here. The market ended up rallying for 5 straight weeks. Let me add the S&P on here so you guys can see what I'm talking about. Here it is. The VIX stopped right there. The market continued to rally for 5 straight weeks as the VIX took out this support line, prior support line. This was the final really big rally in the S&P before the next major leg down. Then we had this bear flag, and this bear flag ended up breaking to the downside in that massive flush down crash and this explosion, absolute massive explosion in the VIX, the volatility index. If you take a look at the VIX today, looks similar. This is the weekly chart. We had this uptrend right here. We had another uptrend right over here, and then we closed below it. We had this top in the VIX in October. It marked that October bottom in the S&P 500 right over here. And we are now taking out this prior low. The VIX will likely continue to go down as the market tries to rally into early February. And that will very likely form either a head and shoulders top or a double top formation with the S&P 500. And the VIX will likely from that point on shoot to the upside, producing the first major sell-off in 2023. So we're seeing a very interesting VIX regime, and I wanted to compare the S&P 500 today to the 2000 bear market. Namely, I wanted to see if at any point in time the bear market in 2000, that lasted between 2000 and 2003, whether at any point in time the S&P 500 closed below the major resistance line. Right, we had this major resistance line. We tagged it once, twice, 3 times, rejected. The third time we closed above it briefly, we went back below it, and then the last time we went significantly above it and crossed and closed above the 200-day moving average. We are likely now At this stage, guys, we're probably going to cross above the resistance line and above the 200-day moving average. So something that looks like this, right? A rally, sell off, another rally, and a double top, or perhaps a rally, another rally, a lower high, and then a sell-off. So one of these possible scenarios, assuming we end up taking this resistance line at the 200-day. Remember, in December, we took it briefly. We had another attempt at taking it. We opened for the first time ever above this resistance line. We went back down, and we will likely try to hit it again. Now let's take a quick look at the smart money. The smart money has taken out this prior high, so the S&P might try to rally to this prior high. That's highly unlikely anytime soon. Probably, if that's going to happen, it will probably take at least 3 to 4 weeks for that to happen. And I do expect that this rally will probably end around the 4 to 5 week mark. First week of February, probably that will mark the end of this rally, in my humble opinion. US 10-year yield broke below this prior support, flushed down. It is now testing this major area of support. We will likely try to take it out if the market decides to close green tomorrow. We take a look at gold. Gold has now made a new high. It is now at a major level of resistance. I'm still waiting for GLD to move all the way back down to 160 for a long entry. This will likely happen sometime late February, maybe early March, so keep your eyes peeled. In terms of a long entry on gold, this does not make a lot of sense, right? The PPO is massively overextended. We have a double top on the PPO with a higher high on the daily chart. So we have this massive divergence. We will likely see something that looks like this. Another high and a lower high on the PPO, marking the top in gold. TLT rallied massively, took out our prior resistance level of 106.5. We are now at 107.7. Massive rally. Still major divergence here, assuming that TLT does not take out these prior highs. It will need to take out these prior highs to neutralize this divergence. That will very likely not happen. Even if we take out this high, we will likely see another divergence, and that will likely mark the top in the TLT. Dollar index continues to move down. It has produced a bearish crossover on the PPO, and so this now looks like a bear flag that is breaking down. We had this descending wedge pattern, which is a bullish pattern, but we never ended up with a rally following this pattern. We are now likely to sell off all the way down to 101.2, so right over here. I will expect the dollar index to find support at this level. The SMH divided by triple Qs is now at the all-time highs. Not a lot of good things happen when the SMH divided by the triple Qs hits an all-time high. It usually marks market tops, right? We had a sell-off here, another one right here, another one right here. So we'll see what happens. This is way overextended, and we'll likely see the semiconductors cooling down. TSMC, Taiwanese Semiconductor Manufacturing Company, did report earnings yesterday. They missed on revenue. They beat on earnings, the bottom line, but that only happened because of price gouging of their 5nm tech. And they're in fact guiding for Q1 2023 at zero growth year on year. They're guiding zero growth, no growth at all year on year, Q1 this year versus Q1 of last year. So we're beginning to see the end of this massive rally in these semiconductors, probably topping sometime in the next couple of weeks ahead of major earnings. Semiconductors will report a lot of earnings in the middle of January into early February. And so I expect a lot of those companies to miss on earnings, or at least guide down for Q1 and the rest of the year. And that will drive this ratio back down and the semiconductor index back down. In terms of breadth, we cleared this prior area of resistance. I expected a rejection here. We'll see. We need to see a sell-off tomorrow. Otherwise, this is a significant development and will indicate a continuation of this rally, perhaps all the way up here, or even taking out this prior high in breadth. We'll see what happens next. Maybe we just go all the way up to a 90% and stall. Usually, guys, at 90%, 90 plus, on breadth, the 50-day S&P 500 breadth. Usually that marks tops, so just be careful. If we continue to see a rally at that point, that will be a major level of resistance, and just watch out for major selling to come right after that point. New York Stock Exchange Composite, look at this. We have hit a significant area of resistance. All of the prior rallies last year failed at this level, guys. So just be aware. You'll have to be very particular about picking stocks in this potential rally. Interestingly, if you noticed, guys, Bed Bath & Beyond is exploding to the moon. AMC is exploding. And we have Carvana exploding to the moon. The meme stock index is rallying. And usually, guys, the meme stock index rallies closer to market tops. This is the meme stock index. And if you notice, guys, when we approach and cross above the 100-day moving average, that usually marks the market top. Like at these times, all mark tops. So we will likely see perhaps another week or two of euphoria in the meme stocks, and then we'll see a massive crash. Again, closer to the end of the month into early February. Let's take a look at the fear and greed. We are now in greed. At this level, we usually see the meme stocks really go insane. Not a lot of good things happen in the stock market. When we hit the greed level, market momentum, we're above the 125-day moving average. And we will likely try to clear this level soon, guys. We will likely try to clear it as soon as next week. Now, interestingly, if I extend this 50-day moving average and this 200-day moving average, they will end up crossing in early February. And if we end up getting a 50-day over 200-day cross, that will mark the end of the bear market. My opinion is that this will not happen. We will get super close to a cross, then the 50-day will cross down, and the 200-day will continue to move down, but we will never get across. That's my opinion at this point in time. I simply do not see the end of the bear market just yet. So to summarize, guys, number one, we're hitting major resistance very soon. We are already nearly there. The weekly expected move is at $398. So if you were long, this makes sense. This level makes sense to take profit. That's number one. Number two, the VIX is indicating that we are probably entering a multi-week uptrend that will probably last into early February, late January. Number three, meme stock mania does indicate as well that we will likely see the market topping within, let's say, the next 2 to 3 weeks. So again, we are in an uptrend. The uptrend is probably ending within a couple of weeks. We'll probably see the market put in a top by late January, early February. And in the meantime, if you have long-term short positions, you will probably be fine. If you have short-term short positions, you will have to be very particular about what you short in the market, because we are seeing breadth expand, and when breadth expand, more and more companies participate in this rally. In terms of upside, guys, not a lot of upside left in the S&P. We might try to rally to 400 within the next couple of days. We might even try to take out these prior highs. I really doubt that we will take the prior high of 410. Very unlikely. We'll likely see something that looks like this again. We clear the 200-day. We might even clear the descending resistance line. We go back down, form a double top, confirming this head and shoulders pattern. In terms of long side trades, I do see some upside, particularly in some of the most hard hit areas of the market. Things like Tesla. I like Tesla at this level. Things like software. I like software. As yields go down, software will explode. You know, the exact opposite things that happened in early 2021, right? Where yields moved up and software was going down. When yields move down, software names will move up because they have super high margins, low head counts, very fast growth. So they have that massive growth premium, and so they have these big valuations. These valuations usually get crushed when yields are moving up, and these valuations expand when yields are moving down. So I like software. I like Tesla. Just be very particular about picking your stocks. In terms of the index, going long the index at this level, I'm not sure about that. Personally, I'm not sure really about that. Going long the index, I wouldn't say I like that. In fact, I've been actually adding more and more long-term short positions as we've been rallying. That's all, folks. That's all I have for today. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.